So, Mr. Ricardo, could you tell me a little bit about your background? Because obviously you started out in kind of conventional banking a little while ago.
Yeah, let me step back a little bit. So, I grew up in Zimbabwe back in the 80s, and I suppose I was 16 years old when the Zimbabwe dollar went into hyperinflation. And as a 16-year-old, you're looking at 20,000% inflation day by day, and at some point it got to about 1 billion%.
Wow.
And so, super curious at 16, trying to figure out, how money works and how all of a sudden money goes into kind of hyperinflation, and the curiosity on money, creation of money, its value, how it works, and so on, kind of stems from there. And so today, the work that I do working with R3 is really looking at central bank digital currencies and commercial bank digital currencies. So, how is the format of money changing? And the format of money hasn't changed for a few hundred years there. We've had paper money and coins for the longest time, and now we're starting to see a transition into digital. Of course, that's spurred on by a whole bunch of things, notwithstanding crypto, which I think has been the biggest kind of catalyst for
Hmm.
the regulated sector to really look at money and digital money seriously. So I did start in conventional banking, but always really on the innovation side of banking, understanding how, again, how money works, what the role of banks are, what the role of the central bank is, how money's created, how money's distributed, and what alternative forms of money there are. So that's kind of the background.
Okay. So you talk about kind of hyperinflation. There's obviously challenges there. And I think a lot of people, when they think about digital currencies, see a lot of challenges. There was a massive pull to buy crypto. People were, when Lambo, when am I going to get my Lamborghini, and making a fortune. And there's claims of pyramid schemes and all kind of stuff like that, and then you start to see challenges with some of the new startups in your Binances and people like that, and how they're running, they're unregulated. There's a really big trade-off, isn't there, between regulated banks and the stability, or so-called perceived stability, and then these new kind of digital currencies and the people that surround them and not being regulated. Do you have a view on that?
Yeah, I mean, so you said perceived stability. That's kind of interesting, right? Because, you could argue that, the stable system is not as stable as we'd think.
Hmm.
And so, the perception of stability is provided by, regulated entities that have compliance against the things that they do, and checks and balances and a whole bunch of things to at least provide as much stability as possible. Um, but still, if you look at the mechanism on how money is created, and let's just start there for a second. Like, we spent a lot of time thinking about how money is created. So first of all, there's this notion of fractional banking, and that's quite old. I don't think we have fractional banking in its initial concept alive today. There are forms of it, but I think the initial fractional banking approach was, hey, the central bank gives you, $10, and therefore you're able to create $100 of loan, right? So you can 10x what the reserves are that you have. Today, you'd say that actually the way that money is created is Richard walks into the bank. He wants to buy a house for $1 million. And at that point, the bank creates $1 million for Richard. They go to the ledger, they create a liability on one side, create an asset on the other side, and at that very moment, money is created. So money is created today during the function of enabling loans, and loans come in the form of mortgages, credit cards, credit, and kind of business lines, and so on and so forth. All that is just money creation, right? And so, in a way, kind of money is created out of thin air. We say it's not quite thin air, and I know people kind of get kind of sensitive with that. So if you look at kind of the current regulated system that's been operating for many years, and you look at kind of the crypto that's just emerged over the last, you'd argue, 10, 15 odd years, not even 2009. There are certain things that you take away from both to say, there's good and bad in both sides. what I do really like about the crypto side is, you've got more real-time impact on monetary policy. So, here today, you've seen inflation throughout the world. You've seen the central banks hiking for 12, 13, 14 months. And then you sit and wait for 6 months to see what the impact of those hikes will be. Arguably, with a more digital form of money, you have a more real-time impact view. Like if I up the inflation rate, what is the impact across the ecosystem? And so you're able to see a much shorter view of the impact versus sitting and waiting and hoping that consumer confidence is going to pop up and Richard's going to go back onto the street and buy stuff, right? So so there's certain things that are good and bad. It's not to say that it's not all bad. I think we can take tremendous learnings from the crypto side. I know that there was kind of super hype on DeFi and NFTs, and those things are morphing into other things like purpose-driven tokens, if you've heard of that. It's the new NFT, purpose-driven token. It's for a particular purpose. It's non-fungible. So yeah, I think, the way that I see it is I think there's a future where we can have coexistence and the emergence of a new financial infrastructure that is kind of modern, more real-time, and allows us to kind of prepare for, if you believe in the Web3s and kind of the digital age that we're kind of embarking on, I think we do need a new form of money to be able to participate.
Yeah. No, I think that makes perfect sense. Just if you think about how we trade, how we work, how we pay each other, and how small the world is now because everything is global, we do need to be able to kind of transfer money, don't we, between people and institutions a lot more quickly. And I think one of the key things, and you kind of alluded to it in there, is about that visibility and that quick visibility. And when you think about what the blockchain has done under there and having visibility of transactions and ledgers and being able to see into the financial institutions and understand their position is quite interesting. I think when you see outside organizations basically saying, you seem to have lost a lot of money off your balance sheet here, and being able to question things. Whereas obviously when the financial crisis hit, everything seemed to come out, didn't it? And it was very much behind the closed walls of the financial institutions.
We don't quite know how things are operating, and it's made complex by design, and it's designed by the banks for the banks, and all this conspiracy stuff, you could say. Right? But I think if you put all that aside, we're talking about digital money, but it's also digital assets, right? So things like being able to move money around the world at the speed of an email. We're seeing some of that today, Revolut and TransferWise and others that have created models to do that. It's still not real-time settled, though. I mean, those things are perceived settlement between you and I, but there's end of day and intraday processes that run in the background to manage settlement kind of finality, if you like. There's a lot of inefficiency and cost in that, right? So we talk about things like Bitcoin being very heavy and not very green and so on and so forth, which is true. It's not. But if you take the entire financial system today globally, I mean, how much are we burning, man?
Yeah.
We've really got to measure apples for apples, and oftentimes we don't. And then just coming back to kind of not only digital money, but digital assets, the fun thing to think about is, things like fractionalization of stuff. If I have a house and I'd like to just sell 10% of it because I need to raise some capital, why wouldn't I be able to do that in a secondary market just by myself, right? I can fractionalize the property, put out a whole bunch of tokens, sell it in a secondary market in a safe space, right? Under certain conditions, using smart contracts and what have you. But that's fun to think about. So, kind of everything becoming a little bit more liquid. And if you like, again, somewhat controversial, the power shift from corporate to individual, where we're in control as well. That's fun. It's like, why shouldn't we be? It's our assets and our stuff. Digital identity is the other one. Like, I logged in here today. Someone's got my digital details. I log into my portal at Google's and my government kind of portals and what have you, and you're completely distributed. but I should have control of my digital me as I have control of my physical me. So, those things are fun to think about. It's not just the digitization of money. The three things for me that I like to think about is money, assets, and identity. And those three things arguably are the pillars of a Web3 economy.
Yeah.